Okay, this video deals with Chapter 8, which is the consolidation of foreign subsidiaries. So we go back to our consolidation rules and our consolidation journal entries, but then now we have one step prior to being able to consolidate. We need to translate those subsidiaries' financial statements from whatever their local currency is that they're using, their functional currency, and translate it into US dollars. So we'll have to do that for the whole thing. So our statement of retained earnings, our income statement or statement of retained earnings and our balance sheet. So then what you do is they'll give us their financial statements, and in this example that I'm reading over, they're giving it to us in the Brazilian real. So then we have to take those and convert them from the Brazilian real into US dollars. So if we've got our income statement, we've got sales. And then our sales are $5,818,500, 500 Brazilian reals. And then when we're dealing with the income statement, we're going to use the average exchange rate. So then we multiply that by 0.51. So they're always going to give us the exchange rates. We just have to know which ones to use, because there'll be a whole table of those. And the reason the income statement uses the average rate is because the income statement is it's transactions for the entire year, from the beginning of the year to the end of the year. So the average rate is the most logical one to use. So then we translate that out, and then now this will be in US dollars. So it is $2,967,435. Then we do the same thing to our cost of goods sold, and then those are $3,491,100, again in the Brazilian reals. Multiply that by 0.51, and that gives us $1,780,461. And then we can subtract that to get to our gross profit. And then from that gross profit, then we're going to subtract out our operating expenses. And those are $1,521,810, again in the Brazilian real. Multiply that by 0.51 to convert it into US dollars. And that gives us $776,123. So then our profit then is going to be, net income is going to be $410,851. So then that's kind of our step one. Then we look down to our statement of retained earnings. Now with the statement of retained earnings, it tells you, so this is something to remember. It's going to say our beginning of the year retained earnings. It tells us that they are 3,054,712 Brazilian reals, but in the problem it'll tell us that assume that the beginning of the year retained earnings is 1,116,667. So this is given. So then you'll never have to compute that. They just give us the answer. So $1,116,667. Then your dividends, then your net income rolls from above. So then we don't have to worry about translating that either. Then your dividends you do have to translate, but then the dividends are not going to be at an average rate. So the dividends on the table are 81,459, again Brazilian reals. But if we go to the exchange rate table, it tells us that there was an exchange rate on the dividend date. So we're going to use that. So on the dividend rate to use is 56 cents. So then that's what we actually use. So then when we take that 81,459 times 0.56, we get $45,617. And then we can subtotal those. And then that gives us $1,481,901. And that is going to roll to the balance sheet. So I'm going to jot that number down here at the bottom because I'm going to have to erase this and start the balance sheet up at the top. So when we translate our income statement, we use the average exchange rate. When we translate the statement of retained earnings, the beginning of the year will be given to us. Know that your net income rolls from your translated income statement, and then you convert the dividends at the exchange rate that the dividends were issued. Okay, then we move on to the balance sheet. Now the balance sheet you're going to convert at the end of the year rate. So we've got cash, and the cash balance is 1,655,944 Brazilian reals. Our accounts receivable is 1,349,892 of the Brazilian reals. Inventory is 1,733,914, and then we have property, plant, and equipment, 3,207,157. Okay, then we would have our total assets, but I'll do those when we add them up over there. Then we move down to our liabilities and our equity. So we've got current liabilities, and then those are 986,818. We've got long-term liabilities, and those are 2,299,471. Then we have common stock, paid in capital, and then retained earnings. And then the common stock is 387,900. Our paid in capital is 484,875. And then the retained earnings, it doesn't really matter because it's going to roll. So then now we go through there once again. This is just information that they're given to us off of their balance sheet in the Brazilian real. But then we're going to then convert it. So how we convert the balance sheet, for the most of it, we go to the end of the year rate. So again, that's given to us in a table. The end of the year rate is 57 cents. Now I can go all the way down to then my long-term liabilities. When I get to the common stock and the paid in capital, those equity accounts, those they give us a historical rate. So there's a historical rate used for the common stock and the paid in capital, and that is 40 cents. And then remember the retained earnings rolls. So my retained earnings balance, I can go ahead and slide it in. It was $1,481,901, again, coming from my statement of retained earnings. So then the rest of these we can just multiply across times that exchange rate to put it into US dollars. So that gives me $943,888. And I'm going to leave the cents off to make it easier, and the book will also do that. Okay, then we move to the next one, 1,349,892 times 0.57. That gives us 769,438. Okay, then multiply that across 988,331, again rounding it up. And then that gives me $1,828,079. Now then I'm going to subtotal those because that's all my assets, okay? So then I can add those up. And that gives me $4,529,736. Then I can start into my liabilities. And that gives me $562,486. Okay, then the common stock and the paid-in capital, again, at that historical rate, so it's going to be lower. And then that is, so then if you're just kind of following this, obviously if I translate all of my assets at the end of the year rate, and then I come down to my liabilities and my equity and I'm translating those at different rates, or I'm letting them roll in from another statement, there's no way that these are going to balance. So that's our next step, is to say, okay, well, how far off are we? So what I'm going to do here to the side is I'm going to run a little subtotal of the liabilities and the equity and see how far off we are. So I get $3,704,195. And I might just double check that just to make sure I didn't add anything up incorrectly. Okay, but I did not. So then our difference, if we look at that, is the $4,529,736 minus the $3,704,195. I've got an $825,541 adjustment that needs to go into here. And what this is called is it's called a cumulative translation adjustment. So it's what we need to make this balance. It's our plug. Then now if we total those up, though, our assets equal our liabilities and our owner's equity. And then we have our translated statements. So we have our translated income statement, our translated statement of retained earnings, and then now our translated balance sheet. And then what we end up doing then is using these translated numbers and then going into our consolidation. So we're going to take this as our subs numbers, what we've translated, add those to the parents, and then still make the regular adjustments that we are going to end up making. Okay, so then that is that. So that's our first step. And it is kind of time consuming, but just know your rules, and then hopefully that is fairly easy kind of once you get the hang of it, how we translate those. Then we can go into, though, our regular entries. To consolidate. So then that's when I'm going to kind of, let me put this up because now I erased everything. I want to make sure I got the translated numbers here for myself. Okay, yes I do. Alright, so there they are. Okay, so then now as we move into it, though, then we look at it and it tells us that they give us the parents' balance sheet, and then they say assume the following information, that there's a purchase price for the sub included in acquisition accounting premium asset related to a patent, and the parent estimates that was worth $300,000